Overall, there's some really strong factors driving an improvement in growth in 2026. We've got rising household disposable incomes, lower inflation, and interest rate cuts flowing through the system, both at home and overseas. But we also have a huge amount of volatility and uncertainty, and we can't take anything for granted.
Most of the jobs growth over the past 12 months has been in the non-market sector. Now that's education, healthcare, and public administration. But we are starting to see a transition of jobs growth from this sector into the private economy, which is a really encouraging sign. We have some really important third quarter inflation data out at the end of October. We think that's going to come in a little bit hotter than what we originally expected. And we now see the next interest rate cut from the Reserve Bank of Australia in February next year, rather than November 2025. We could see all that really strong gains recently in income and wealth lead to a stronger than expected pickup in consumer spending or a lower savings rate. But at the same time, we could also see a delayed interest rate cutting cycle and a shallow interest rate cutting cycle by the Reserve Bank of Australia lead households to lift the savings rate and slow down consumer spending. So we definitely see risks in either direction for the consumer.
In the current environment with the flare-up of trade tensions between the US and China, we think there are significant downside risks to the Australian dollar. We don't expect the Australian dollar to test 60 US cents like it did in early April. Once the trade tensions between the US and China stabilise, we expect that the Australian dollar will be able to increase quite significantly over the next few quarters.
Overall, we expect the Australian economy to strike a middle path.